Today we have Besa, Deda, Chief Economist of Business Banking at Westpac Bank. Besa, we are having a pretty good run with the economy right now, especially after the pandemic. So thought of running a few questions through so that it will be valuable for our viewers today. Going back to the basics of economic indicators in Australia, what do you think the CPI or Consumer Performance Index will be in the next 3 years, and what do you think are the reasons for it?
The underlying inflation rate is very anemic. It grew by just 1.1% in the year to the March quarter, after growing by almost a similar pace in the December quarter of last year. We expect inflationary pressures will build due to pent-up demand after last year's lockdown, closed international borders and global supply chain disruptions. However, we see the pickup in consumer prices as mostly temporary. Importantly, policymakers look through transitory effects. The Reserve Bank has flagged that it does not expect to lift the cash rate before 2024 because it does not expect the conditions required to lift the cash rate to be met before this time. The key condition is that actual inflation growth needs to be in the Reserve Bank's 2 to 3% inflation target band on a sustained basis. The RBA's own set of forecasts published just this month had the underlying inflation rate not reaching the target band until 2023.
And with the current pandemic, do you think the population growth will slow down in Australia, Besa, in the next 2 to 3 years?
Population growth has slowed to its softest pace in more than 100 years due to immigration stalling and international borders closing. The federal budget was handed down in early May, and the underlying assumption in the budget was that international borders will start reopening around the middle of next year. Australia has suppressed the virus incredibly well with minimal economic costs compared to other major economies around the world. This successful suppression was helped by the closure of international borders, but that comes at a cost of slower population growth and growing complaints from businesses of labour shortages. The border closure is also weighing on particular industries, especially education and tourism industries.
We are having a pretty good run on the economy, Besa. What is your prediction for the GDP to be in the next 3 years?
The Australian economy has recorded a faster economic recovery than expected at the start and height of the pandemic last year. Indeed, GDP contracted by 1.1% last year, which is a much smaller contraction than the 6 to 8% contraction expected early on in the crisis. Consumer spending has led the recovery, underpinned by low interest rates, falling unemployment, elevated consumer confidence, support payments from state and federal governments, as well as a housing price boom. We're anticipating GDP growth of an average of 3.1% over the next 3 years. This is well above the long-run growth rate of the economy. We also anticipate that the recovery will broaden out and deepen to other sectors in the economy over time.
And from a construction point of view, I understand construction industry contributes about 13% to the economy. What are the other main drivers for the economic growth right now?
The main driver for economic growth through this recovery so far has been the consumer. Consumer spending has been very volatile, but it's been incredibly resilient. There have been shifts in spending, but even with that, the consumer has been incredibly resilient through this pandemic, and it has supported the economic growth story. Developments in the housing market are very critical to the health and the growth of the Australian economy. The housing market has deep direct and indirect linkages to other parts of the economy, labour market and the financial system. Initiatives from the federal and state governments and extremely low interest rates have helped propel a recovery in the housing market. The initiatives from governments have included home builder and incentives for first home buyers. Dwelling prices are accelerating. Nationally, they're up more than 10% in April 2021 from their trough in September of last year. Higher prices and these government initiatives have contributed to a lift in building approvals, which has flowed on to higher residential construction activity. Building approvals in March 2021 are up 86% since their low in June last year, which suggests the pipeline is growing for residential construction. The lift in dwelling prices tends to also boost the wealth of consumers, giving support, as I said, to consumer spending, which accounts for a large share of overall economic output. It is consumer spending, as I said, that's been leading this recovery so far, and we expect that business spending will also drive this recovery as we move through this year.
And would you see the interest rates rising in the next 3 years as a result of economic growth?
The Reserve Bank has strongly suggested it will not be hiking the cash rate until actual inflation is sustainably in its target band, and that it does not expect this to occur before 2024. Variable mortgage rates typically shift when the Reserve Bank changes the cash rate, so variable mortgage rates are likely to stay low for some time. The cash rate sets the structure of other interest rates along the bond and swap yield curve. However, these other interest rates, especially for longer dated bonds, are also influenced by expectations about inflation and growth in the future. Longer dated bond and swap yields are also critically influenced by what happens with US long-end yields. The Reserve Bank has a yield curve control program where it is buying and selling bonds to target the 3-year government bond yield to be at around 0.1%, the same rate as the cash rate. Initially, the target was for the April 2023 bond maturity. Subsequently, the target was changed to the April 2024 maturity when it became the closest maturity to the 3-year horizon. The Reserve Bank also has a quantitative easing program where it is buying 100 billion of government bonds in the secondary market with maturities of 5 through to 10 years. The weekly pace is 5 billion, so this program is due to end in late August. This QE program keeps bond and swap yields and therefore lending rates lower than otherwise would be the case. The overall aim of these monetary policy actions has been to support economic activity. We expect the QE program will be expended for another 6 months. Whilst the yield curve control program and QE program has kept lending rates low, swap rates have still moved off their lows of late last year as investors have reassessed the economic and inflation outlook. Once these programs taper and/or expire, there is likely to be more upward pressure flowing on swap rates and therefore fixed home loan rates. So one could say fixed home loan rates are about as low as they're going to get right now.
While the property market is booming right now, what are your forecasts for the property market in the next 3 years, Besa?
Dwelling prices are being propelled higher by low stock levels, low interest rates, and falling unemployment. The upturn so far has been primarily driven by owner-occupiers and first home buyers. Demand has also been strongest for dwellings in regional areas and smaller capital cities. However, investors are now joining the party and interest is returning to the larger capital cities. We expect dwelling prices to grow by around 15 to 20% this calendar year, followed by growth of between 5 and 10% next year, and we expect more modest growth in 2023. Housing supply will lift over the next few years, and the stretching of affordability will contribute to a slower rate of growth next year and the year after. Key swing factors in determining how far prices will run up over the next few years include when the international borders lift and immigration resumes, and whether regulators tighten macroprudential regulation. We think there is a risk that macroprudential regulation is tighter next year, and that could see the pace of growth temper.
And currently the Australian dollar is sitting at about 77 cents over the US. Do you think the AUD will remain strong at these levels for the next year as well?
The prospects for growth in the global economy have improved with the rollout of vaccines in the major economies around the world. This stronger growth in the global economy, coupled with elevated prices for commodity prices, especially iron ore, are underpinning demand for the Australian dollar. Since hitting a low of 55.1 US cents in March of 2020, the Australian dollar has reached a high of 80.07 US cents in February of this year. We expect the Australian dollar to have an 8 in front of it against the US dollar by the end of this year and move higher still over next year. However, the Australian dollar is likely to be subject to considerable volatility, with investment markets trying to work out when the US Federal Reserve and Australia's Reserve Bank will begin tapering of their quantitative easing programs.
And overall, as I said before, we have had a pretty good run right after the pandemic. What do you think the government will focus on to drive the economic growth in the next 5 to 10 years, Besa?
It's a very good question. The federal budget gives us a bit of an idea of the blueprint for economic growth over the next few years. The federal budget this year focused on trying to drive the unemployment rate below 5% and sustaining the economic recovery underway. Key initiatives included extending the loss carryback scheme and instant asset write-off for businesses so as to spur business spending to support jobs growth and consumer spending in the economy. There was also tax relief provided to low to middle income households via the extension of the low and middle income tax offset. Infrastructure spending remained a big plank of the federal government's short-term and longer-term plans to lift economic activity and support jobs. However, many of the measures in this year's federal budget were not new measures per se, but rather a tinkering of existing measures. For longer-term growth, structural reform to lift productivity is needed, and this reform should ideally include tax reform.
Thank you so much, Besa. That was very, very valuable information. Golden nuggets dropped right there. Thank you so much. Please feel free to ask any questions you might have for Besa, and we are more than happy to answer your questions.